Exercise 10-25. A company is going to purchase some intangible assets and then they will amortize them. So Medway Printers manufactures printers. Assume the company recently paid $900,000 for a patent on a new laser printer. Although it gives legal protections for 20 years, the patent is expected to provide a competitive advantage for only 8 years. So the useful life will be 8 years, not the 20. Requirement 1. Assuming the straight line method of amortization, make journal entries to record A, the purchase of the patent, and B, the amortization for the first full year. So in this journal entry here, we're going to record the purchase of the patent. So the patent is an intangible asset called patent. And the company paid cash for it. To record purchase of a patent. Now we're going to record amortization for the first full year. So when we're doing amortization, we use the straight line method. And intangible assets usually have a residual value of 0. So that's what we're going to use here. So the formula is cost minus residual value divided by useful life. The useful life is 8 years, which we get from up here. And the cost is the $900,000, which we get from up here. So $900,000 divided by 8 years gives us $112,500 of amortization per year. Now the debit account is amortization expense on the patent, and then the account that's going to be lowering the value of the patent, it's going to be lowering the patent account directly. There is no there is no accumulated amortization on the patent. You just directly lower the patent's value as it's amortized. To record amortization of patent. And remember, amortization is just a fancy word for taking the cost of the patent, the $900,000, and dividing it over those 8 years equally. Requirement 2. After using the patent for 4 years, the company learns at an industry trade show that another company is designing a more efficient printer. On the basis of the new information, the company decides, starting with year 5, to amortize the remaining cost of the patent over 2 remaining years, giving the patent a total useful life of 6 years. So it's not going to last the 8 years that they expected up here. It's only going to last 6 years. So starting in year 5, we're going to amortize it over only 2 more years. And the amount that we have to amortize is the remaining book value. So we have to calculate the book value after 4 years of using the the patent normally. So our first task is to figure out how much amortization has accumulated over the first 4 years. And remember, up here we have $112,500 of amortization for 1 year. So we're just going to simply multiply that times 4 years, and that gives us an accumulated amortization of $450,000. So we now have to calculate the book value after 4 years. So the book value after 4 years, remember, book value is cost minus the accumulated amortization. And so the cost was $900,000. We're going to subtract this $450,000. So it gives us a book value of $450,000. So after 4 years of using it, on our books, the patent has a book value of $450,000. Now we need to calculate our revised amortization. So the way we do that is we take the book value and we subtract the revised residual value, which is still 0, and then divide by the revised useful life remaining. And the useful life remaining is only 2 years according to this. So if we take the book value, $450,000, divided by 2 years, gives us $225,000 of amortization for those 2 remaining years. And that's per year. So $225,000. Copy and paste. And so the journal entry is just like this. Amortization expense is increasing with a debit, and then the patent is being lowered directly. And the explanation is to record amortization of a patent. And that's it.